John Bogle and Vanguard, the man who told you not to be clever. Valley Forge, Pennsylvania, mid-1970s. In a low concrete building, surrounded by parking lots and trees, a man in a plain suit is staring at a stack of numbers. He's not on Wall Street, he's not on television. There are no flashing screens or screaming traders here. Just mutual fund performance tables, fees, returns. On the surface it looks boring. To John Bogle, it looks infuriating. Because the numbers are telling him a story that most of the financial industry does not want to hear. It goes like this. Most people who try to beat the market do not. And the more they pay for the privilege of trying, the worse it gets. Jack Bogle, as almost everyone ends up calling him, is not born into money. He's born into a comfortable family in New Jersey in 1929 at the edge of the Great Depression. The crash hits them hard. His father struggles. There is instability. Young Jack learns early that prosperity is not a given. He also learns that discipline and numbers can be a kind of shelter. He works hard enough in school to win a scholarship to Princeton. There, he writes his senior thesis on mutual funds, the relatively new vehicles that let ordinary investors pool their money and own diversified portfolios of stocks. He is fascinated by the idea. In theory, funds should be a boon for small investors. Professional managers, diversification, access to markets that individuals cannot easily reach on their own. In practice, he notices something else. When funds charge high fees and trade a lot, the drag on returns is huge. The industry makes money whether the customers do or not. Fresh out of college, Bogle lands a job at Wellington, one of the oldest balanced funds in the United States. He climbs the ladder quickly. He's smart, driven, a true believer in the mutual fund concept. In the go-go 1960s, though, he makes a decision that will nearly end his career. He supports a merger that pulls Wellington into the hot world of aggressive growth funds. Momentum chasing, flashy managers, high turnover, stuff that sells well when markets are climbing. Then, as they always eventually do, markets turn. The aggressive funds get hammered. Performance tanks. Clients are angry. The board looks for someone to blame. Bogle, the man who championed the merger, is fired. In his 40s, with a family, a mortgage, and a reputation dented, he is out. If this were a different kind of story, this might be the end. Instead, Bogle does something quietly radical. He negotiates a way to start a new company that will handle the boring back office work for the Wellington funds. Administration, record keeping, the stuff most people ignore. He calls it the Vanguard Group, after Admiral Nelson's flagship at the Battle of the Nile. It is, legally, owned by the funds themselves, which means it is, indirectly, owned by the investors in those funds. No outside shareholders, no stock listing. If Vanguard makes a profit, it can lower its fees. That ownership structure is the seed of something bigger. Bogle now has a platform, however modest, on which he can experiment. And he has a chip on his shoulder. Around this time, academic research is starting to gnaw at the deeply held Wall Street belief. The belief that talented stock pickers can consistently beat the market. Economists and statisticians at places like the University of Chicago crunch decades of data and find that once you adjust for costs and risk, most active managers underperform broad indexes. Not every year, but over long spans. Bogle reads this research and sees it as a confirmation of what he has suspected since his thesis days. High costs are the enemy. Trying to outguess everyone else is, for most people, a losing game. So he asks a question that sounds, to his peers, like giving up. What if you did not try to beat the market at all? What if you simply bought all the stocks in a broad index in proportion to their size, held them, kept costs as low as humanly possible, and let the average return of capitalism accrue to you? No star manager, no market timing, just owning the whole thing. This is the birth of the index fund. In 1976, Vanguard launches the first index investment trust designed to track the S&P 500. The response from the industry is not applause, it is mockery. Competitors call it un-American. They deride it as Bogle's folly. Brokers do not want to sell a fund that does not pay them juicy commissions or promise market-beating brilliance. Even some academics who like the theory doubt it will catch on. Who wants to settle for average? But Bogle is stubborn. He points out that average before costs is actually pretty good. If the market as a whole returns, say, 10%, and you capture 9.5 by paying almost nothing in fees, while the average active fund returns 7 or 8 after fees and trading costs, then average starts to look like outperformance. He pounds this point in speeches, interviews, and above all, in his letters and books aimed at ordinary investors. Costs matter, diversification matters, time matters. Everything else is noise. Indexing does not conquer the world overnight. For years it is a niche. Bogle and Vanguard build other low-cost funds too. Bond funds, balance funds. They hammer away at the fee structure, relentlessly lowering expenses ratios as their scale grows. They refuse to pay commissions to brokers, preferring to attract investors directly. They position themselves almost as an anti-Wall Street firm. No fancy headquarters in Manhattan, no sales culture, just a drumbeat. Own broad funds, minimize costs, say the curse. Slowly, something shifts. Large institutions, like pension funds and endowments, start to see the appealing of indexing. They realize that paying active managers high fees for middling results is hard to justify to their boards. Individual investors begin to hear about index funds through financial writers and planners who are tired of watching clients churn themselves into poor outcomes. Vanguard's assets under management swell from millions to billions to trillions. The index is no longer a weird academic toy. It is the default. Jack Bogle's public persona evolves alongside this. He becomes a kind of grumpy prophet. He rails against what he calls the cost of capitalism, eating away at what he sees as the returns of capitalism. He attacks marketing-driven funds, excessive turnover, opaque fee structures. He tells people bluntly that most of the financial industry is in the business of taking a slice of their nest egg every year, whether or not it adds value. His solution is almost comically simple. Buy a low-cost index fund, add to it regularly, do not look at it too often, do not jump in and out because of headlines. Do not pay extra because someone in a nice suit says they can do better. In an era obsessed with cleverness, he preaches boredom. As Vanguard grows, it turns into something historically odd. It is one of the largest asset managers in the world. Yet, it is structured as a kind of cooperative. Its investors own the funds. The funds own Vanguard. There is no external shareholder class demanding higher profits. In theory, this keeps its incentives more closely aligned with its clients. In practice, it also makes it a quiet behemoth. Vanguard ends up owning, on behalf of investors, large chunks of almost every major public company. It does not run those companies. It just votes its shares on corporate matters and collects dividends. But the scale is huge. Its very existence changes the texture of markets. Trading in and out of individual stocks matters less when so much money is just quietly buying and holding the whole index. The idea of stock picking as a hobby looks, against this backdrop, like a sideshow. Not everyone is thrilled about this new world. Critics worry that the rise of indexing could distort price discovery. If a large and growing share of money just buys whatever is in the index, regardless of valuation, who is left to set prices based on careful analysis? Others worry about concentration. Between Vanguard, BlackRock, and a few other giants, a massive slice of corporate America is held by a small number of asset managers. They can influence executive pay, climate policies, merger votes. They insist they are just stewards for their clients, following broad governance principles, not puppet masters. Still, the sight of a handful of firms voting on behalf of millions of small investors raises hard questions about power. Bogle himself, in his later years, expresses concern about the sheer size and influence of index giants, including Vanguard. He remains proud of what indexing has done for investors, but wary of what happens when too much of anything dominates. John Bogle dies in 2019. By then, he has become something unusual in finance. A cult hero for telling people to expect less and be happier with it. He does not claim to have created wealth out of thin air. He claims to have helped people keep more of what markets already offer by slicing away layers of unnecessary cost and ego. His legacy is not a flashy trading strategy or a secret formula. It is an idea about fairness, that the investor should own the lion's share of the return, not rent it. That humility about our ability to predict the future is not weakness, it is wisdom. And above all, that simplicity can be a radical force in a field that profits from complexity. But the story does not end with one man and one firm. Bogle may have been the first to build a giant machine for low-cost indexing, but he's not the last. As his idea spread, other asset managers adapt. Some fight it, some copy it. One, in particular, leans into it so aggressively that it becomes, in a few decades, the largest asset manager on Earth. It starts in the bond world as a little risk management and analytics shop, helping institutions understand their portfolios. It builds a software platform called Aladdin that peers into trillions of dollars in assets, tracking risk and correlations across the globe. It buys an index fund business, then rides the wave that Bogle started, offering exchange-traded funds that track everything from broad markets to narrow slices of sectors and themes. Corporations, pension funds, sovereign wealth funds, and small investors all pour money in. Before long, this firm is not just a player in the ETF world. It is a quiet shareholder in almost every major company you can name. Its CEO is not a folksy crusader in Pennsylvania, but a New York bond trader turned statesman of finance, flying between capitals, talking about long-term value, climate risk, and the responsibility that come with managing other people's money at planetary scale. His name is Larry Fink. The firm is BlackRock. Next time, we will move from Bogle's investor-owned Vanguard to the world of the asset superpower, where risk models run on server farms, index funds shape corporate ownership, and one company sits in the middle of more balance sheets than almost everyone else on Earth. If John Bogle and Vanguard showed us how to let everyone own the market cheaply, Larry Fink and BlackRock will show us what happens when one platform ends up holding and watching a very large chunk of that market for everyone at once.